my name is Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Service International Limited. And here is your daily technical analysis of foreign exchange markets. I'll start with the euro against the dollar. A reactionary key reversal up and bullish engulfing pattern yesterday, if only just on the latter. This was a reaction to approaching too close to a number of key supports and is not necessarily a pullback upwards. The key supports were and are the upper trend line, currently 116.99, of the recent descending wedge pattern, the neckline, currently 116.95 of the August to September 2020 head and shoulders top, the lesser 38.2% Fibonacci line of the March 2020 to January 2021 move at 116.94, and finally the famous low of late March this year at 117.02. Meanwhile, topside we have the previous support that's now resistance, the 50% Fibonacci line of the June 2020 to January 2021 move at 117.58. So far today, well, not that much. As I mentioned earlier, yesterday's action does not look like a pullback up in depth, so we've been hanging around yesterday's close and started to edge up towards the 50% Fibonacci line overhead, but it's not necessarily a greatly aggressive move at the moment. Cable, aka sterling against the US dollar. Much like euro dollar here, a combined key reversal up and bullish engulfing pattern just yesterday. The latter wasn't that hard to do actually, as the previous session was an indecisive doji cross. However, in this case it wasn't a series of supports that caused a reactionary move back up, but the rising long moving average below, currently at 137.80. Meanwhile, overhead we have the declining short medium moving average, currently at 139.13, and the medium moving average, currently 139.26. Interestingly, I suspect that this pair may have more room on the downside, as apart from some congestion at the 137.50 area, of little below until 136.5, assuming the long moving average is broken again, of course. Now, so far today, not that much, a little bit dip lower, though as I've said, not much. Beyond the short medium moving average overhead, we have the significant trio of famous congestion levels at 139.99, 140.75 and 141.43. Euro sterling. All this week, well, so far, we've had indecisive, if lower patterns here. Yesterday was no exception. This time it was an indecisive doji cross, the lowest close since February 2020. It was also still within the bearish driving force of this market, the May today based bear channel, currently 84.49 to 85.37. The next support of note, below and outside of this bear channel, is down at 83.35. Now, so far today, well, not much. We're close to yesterday's final price of the April low at 84.70 above, but we've just started to move above that. We still have yesterday's low below 84.48. US dollar against the Indian rupee. A second bearish black crow yesterday, but that's not the full story. As you can see, yesterday is also day 3 in a 3-day bearish evening star pattern. Interestingly, the market closed below, if only just, the significant 50% Fibonacci line of the February to April 2020 move at 74.26. I've still left on the daily chart the initial downside target X for the ascending broadening wedge pattern in the 74.05 area, even though it was achieved last week. We also still have a further secondary target X1 in the 73.80 area that's untouched as yet. Well, so far today, another lower open, but this time the action has been different, as prices have immediately backed up over the 50% Fibonacci line at 74.26. I suspect the reason may be the same as last Friday's. Prices strayed too close, too quickly to the rising short medium moving average, currently at 74.06, and its recent less acute partner, the medium moving average, currently 73.96. These two have now, because they've risen so far, have put in doubt the idea of actually achieving target X1. US dollar against the Brazilian real. A reactionary bullish white soldier yesterday, as well as an immediate countering bullish harami. This after the previous session's bearish engulfing pattern. Topside is still limited by the two lesser Fibonacci levels at 525.65 and 526.79, especially on a closing basis. But perhaps more importantly, by the proximity overhead of the declining medium moving average, currently 527.68. Meanwhile, below the lesser Fibonacci level at 520.27 reacted as if nothing was there, as did the rising short moving average, currently 519.30, and it was up to some very recent congestion over the last 2 weeks in the 516.45 area that held up prices. This all still leaves open the one question I've been pondering for weeks now, is whether the move since late June has been purely reactionary or is the beginning of something else. You see, there are arguments for the late June to date action becoming a possible triple top or a bullish halfway hesitation, and this situation still hasn't been settled. And this is all in the shadow of the remarkable number of dead crosses we've seen here since late May. US dollar against the Mexican peso. A bearish black crow, one of the longest we've seen in recent days, and almost a bearish black Mariposa as well. It was a reactionary move back down, much as we saw back 3 weeks ago when the market tested and failed at the overhead declining long moving average, currently 20.11 even. In fact, this was part 2 of the overhead resistance, as the first part was the abrasive, eroding, also declining medium moving average, currently at 20.0074. And that had taken a lot of the bullishness out of the rise from late last week and early this week. It ended up that we were back down well below all the moving averages once again. It seems that perhaps the expedition in recent days that had tried higher had missed the comfort of the attractor to this market now since April. The influential gently declining neckline of the February to March head and shoulders top, currently at 1980.56. This neckline, as I've just mentioned, continues to act as an attractor, and we're once again drawn in towards it. Overall, I suppose I must still see the original recent bullish action as part of the extensive indecision we've seen since mid-April. That's recently started again in late June. Additionally, we're finished once again within the April to May base congestion zone between 1985 to 1995. Now, further down, we have the neckline, currently 1957.14, of the late January to mid-May head and shoulders top acting as a support, plus a support band at 1971.68 that's in between. So far today, a further move lower towards a comforting neckline attractor, though not as far or as hard right now as yesterday was. Thank you for listening. This short version broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Service International Limited. And here comes the final bit.